Hello, everyone. We are Project Group A, and today we will walk you through our strategic analysis of Charles Chocolate's current competitive challenges and provide our recommendations for its strategic evolution. Simply put, the company has little chance of maintaining a sustainable competitive advantage in a saturated local market without evolving into a modern regional chocolate brand focused on premium chocolate. So how does Charles Chocolates grow to become synonymous with premium chocolate throughout the New England area? Looking forward, Charles Chocolates must develop its online retail capabilities by recruiting and training e-commerce focused employees and launch a modernized retail website within the next year. As it stands now, only 5% of the company's sales come from a combined phone and online sales orders, but the future is e-commerce. We must also develop a strategic and dominant regional presence by forming key regional partnerships and by focusing on premium gifting and wholesale channels that can lend legitimacy to the still local brand. The company must also develop a more automated inventory tracking system to minimize waste in its production cycles, and it must lower its costs through increased online sales and maximized production efficiencies. Once Charles Chocolates develops operational efficiency and launches a competitive online sales function, it must then expand its geographical reach towards a national expansion. To that end, let's now turn to an external strategic analysis of the company's position.
Our internal analysis shows that Charles Chocolate competes with a differentiated product. It's best in class and it commands a premium price. As the company's competitive advantage, our analysis shows that the chocolate is being fully exploited as the company's foremost product. However, sales, marketing, and the web teams are not being maximized to their full potential. So as Charles Chocolate grows, it may benefit to separate those divisions into separate business units. Lastly, the website is a huge opportunity. It is not maximized at its current rate of 4% sales contribution and flat growth year over year. So our analysis shows significant opportunity for Charles Chocolates to rebuild the website with a marketing plan that specifically captures and retains customers, especially tourists. Financially, Charles Chocolate is a healthy business with a healthy gross margin. However, high SG&A shows that there may be several areas to tighten up spending for improved returns. Financially, since Charles Chocolate is in a great position, it can use leverage to finance its business growth. Thank you.
Thank you for that information, Teresa. I'm going to talk to you guys about manufacturing. We determined that the less products the company has, the less out of stocks would be a problem for them. There are currently a lot of items that are listed as out of stock on the website, which causes a problem for the consumer, and it lets us know that there are problems in production. We decided that we would implement a new inventory model such as JIT, the just-in-time model for supply chain management, which improves the business while lowering holding costs as well. We also decided that we would upgrade the current operation system to maximize the output of inventory produced on the operations side. And the main question that we decided we would answer was, how do we streamline production? Getting production streamlined is the key to success in the manufacturing part of the business. So improvements to manufacturing and operations at Charles Chocolate will be detrimental to the overarching new strategy needing to take place for scaling and expansion of the business.
I will go over the external analysis, beginning with the PESTI analysis. So the main takeaway in this analysis is to look at the economic factors. We are seeing the BRIC nations, which is Brazil, India, China, Russia, having tremendous growth on this middle class, thus enabling a huge demand growth in the premium chocolate market. Another aspect to look into would be the social cultural aspect of things. We're seeing mature markets such as Western Europe and the United States moving towards a more healthier products, such as additive-free, organic, or vegetarian options for them. And one big thing for us is to look into the technological trends, which is the growth for online e-commerce orders. And lastly, Charles Chocolate need to have in mind that there are still some association of forced labor and child labor for the production of cocoa beans. So moving on to the Porter 6 forces, we would say that overall Porter 6 forces have a low influences on the premium chocolate market. For example, we're seeing stiff competition going on, but the market is growing tremendously. So therefore, it's a moderate influence. And due to high barrier to entry, it's also low influence on the low entrance as well. And adding that with end user suppliers, complementary products also have low influences and substitutes have a mild influences. So overall, the economic factor on the external side, it's great for Charles Chocolate.
Thank you, Sonny, for those excellent explanations. Competition in the premium chocolate segments of the United States features strong regional brands and large international players. Godiva, backed by Nestle and its huge retail distribution reach, is considered the best and the most expensive one. Even though Godiva's quality is not as good as that of Charles, it demands a premium of around 200% than that of Charles. Lindt, another large Swiss firm, sells mid-quality chocolate, and it priced around 90% that of Charles. Strong regional players like Dice Chocolate and pricing similar to that of Godiva, and 120 years old Gordon's priced around 30% lower than that of Charles. Now, they all cater to the local tourist population and the corporate houses of New England. Then there are global premium boutique chocolate companies of Belgium. They sell through the premium American retailers, and other worth mentioning national competitors is Ghirardelli of California, and those formidable international players like Ferrosa, Maisy, Hershey of US, Cadbury, very popular in India, and of course, Nestle. Now over to Janelle.
After assessing Charles Chocolate's business as a whole and potential options such as domestic and international expansion, the solution that we recommend is to expand in New England region, to increase sales in e-commerce and make adjustment to pricing. To achieve this, Charles Chocolate should roll out a 5-year plan following the 3-horizon model. In Horizon 1, Charles should focus on physical store expansion outside Portland and Boston to cover every city, every major city in New England area. This should be in year 1 to 2. After a store expansion in Horizon 2, Charles should heavily invest in technology to improve e-commerce sales functionality. This will pave the way for future expansion outside of New England. And we also recommend Charles to increase prices in this horizon as well. This will help fund for technology investment that's spent on enhancing e-commerce functionality. And then aside from that, higher price often perceived as better quality to customer. And we're expecting this to be in year 2 to 3. And then finally, in Horizon 3, Charles will successfully launch its mobile app and have a more sophisticated website. This is in year number 3 to 5. And that concludes our analysis and recommendations. Thank you for listening. I hope you enjoy our presentation. Thank you.